So the market was spooked today and completely sold off. We're going to look at the data and why the market sold off. And more importantly, we're going to dive into the charts and talk about a game plan so that you can protect your account or potentially make money as early as tomorrow. Let's get into it. So the bond yields jumped after the first quarter employment cost index kind of came in higher than expected. Why is that even important? Well, if costs came in higher than expected for employees' costs, it's typically because employers are paying more to bring on an employee, which means basically that there's more money for people to spend to keep inflation high, which is exactly the opposite of what the Fed wants. And so the Fed may keep borrowing costs, aka interest rates, higher for longer. Now that's a problem because the market has been pricing in 2, 3, 4 cuts this year. Then they backed it down to 2 cuts. Now it might be 0 cuts, and the market is like, whoa, we priced in 4 cuts, we're down to 2, and we may get none. That's not a good thing. Let's take a look at the data. Let's take a look at the charts, and let's make some sense of this and how we're going to play this tomorrow. All right, so here's the information that came out. I want to draw your eye to here. So this came out 8:30 in the morning, April 30th, 2024. And the unemployment, or the employment, I should say, compensation costs for civilian workers, you can see right here, increased 1.2%. That means cost for employees went up 1.2%. If you look at this chart, by the way, a lot of this data can be plotted on the chart. If you look at this data, you can see right here, we were in a nice decline. So it's like, all right, we peaked in employment costs going up. And so we had pretty much consistent declines, right? So these are 3-month data points. So you could say this is a quarter. So 1 quarter, 2 quarter, 3 quarters. We had 4 quarters of declining employment costs. Now we had a little bit of a spike here, but then we resumed the downtrend, okay? And again, we had a little bit of a spike here, but then we resumed the downtrend. So essentially, we were headed down just like a broken stock, which was good news. However, this spike up just totally eclipsed the last 1, 2 quarters, actually the last 3 quarters, because this would be the third one. It just totally eclipsed those and jumped up 1.2%, which means that we are going in the wrong direction. We're going in the wrong direction big time because it eclipsed the last 2 quarters of employment costs. So that is not a good sign, especially the day before the Fed is supposed to speak and announce whether they're going to lower or raise interest rates. We already know that they're going to hold interest rates, but it's more about what Jay Powell is going to say afterwards, which is we may not get any rate cuts this year, which is why I believe the market may go lower once those comments come out. Let's take a look at the stock chart and talk about what to do about this information. So if you look here, let's take a look at the S&P 500. A couple things that worry me about the overall market right now. I was talking to our members inside Power Trades University about this on our live session Monday. And I said, guys, we have to be careful because look, we had 1, 2, 3 days up, but guess what? We have 1, 2, 3 days of declining volume. When that volume is declining like that, that typically means the market is running out of gas or running out of steam. We're running out of people who are willing to buy at higher and higher prices. And that's reflected here by this doji that we see, or small body candlestick compared to this one. Look at the body of this candlestick. Look at the body of this one. And then this one, we basically got no body, which is a doji. So we got this run up, declining volume, less and less people willing to buy at higher prices. And then boom, we get a spike in people running from the door and selling, which basically looks like a continuation of the downtrend that we're in. You see, we got this downtrend. You get a little bit of hope, you get smacked down. You get a little bit of hope, smack down. We got a little bit of hope, and I think it's only going to end up rolling over. Now, let me talk about what's not contributing to a rise tomorrow. Number one, we got AMD who reported earnings. They got smacked down 7% after hours, so they're down 11 bucks. That is not going to help the overall market. Amazon posted earnings. They're only up 1.26%. That is not the big pop that we expect like we got out of Microsoft when it gapped up. We had Google, when they reported, they gapped up. Well, guess what? All those stocks are giving back the gap. Google gapped up, now it's selling off. You had Microsoft gapped up. It has completely given back the entire gap up rally. That is not good news for the market. Look at Tesla, another stock that's in the S&P 500. They announced earnings, gapped up. Then they said, oh, some autonomous driving got approved in China, ran up a little bit more, and then they gave up 15 points and it's starting to roll over. If you zoom out, it's still in this downtrend that we talked about with our traders that I think you got to be careful and consider taking profits because it's back up to that line where I think it's going to roll over. So when you look at the S&P 500, this rollover happened before the market closed. That means it's not taken into effect that AMD came in alignment with earnings, but the market didn't care, sold off. It didn't come. That doesn't take an effect that Amazon released earnings only up 1.2%, which they probably will give all that back by tomorrow. And then if the Fed comes on and says, you know what, we don't see a reason to cut interest rates, maybe not at all this year, that is more bad news for the market. Here's the simple way that I think you can play it. I think you take a look at the SPX or you take a look at the SPY. It is a good chance the market is coming back down to test this low right here. I think we're coming back down to test this low. So from 501.98, let's just call it 502. I think the market can come back down to 495, which is a 7-point drop. Or if you're looking at the SPX, that is a 70-point potential drop on the SPX. I think we come back down here, especially if Powell says what I think he's going to say, which is we're staying higher for longer. So protect your account. This is definitely the time to be considering put options because this isn't like, oh, a little bit of bounce and it come back. This is like we have to unwind the fact that we thought we were going to get like 5 to 6 rate cuts down to 4, down to 2, down to possibly none, which totally changes the entire rally that we've gotten since the beginning of this year. A lot of that might be about to get undone. Power traders inside the university, we'll be talking about specific options to potentially look at. But YouTube Nation, I think you got to protect your account and start looking at how you can potentially play this to the downside because bullish is not the move for tomorrow. Let me know in the comments. You got some put options, you protecting your account, or you just sitting on the sidelines, or are you part of the hope and pray team? You just hope and pray it go back up so you can break even. I hope that's not your strategy. Let me know in the comments. I'll see you on the next one.